What if I told you the difference between retiring with $1 million versus $2 million is actually bigger than the difference between retiring with $2 and $5 million? It sounds like a math error because the jump from $2 to $5 million is $3 million versus the jump from 1 to 2 is only $1 million. But here's the thing. Retirement isn't just about money. There are three completely different problems depending on where you land, and money solves each one in a different way. At $1 million, I think the core problem you have is a math problem. You're trying to calculate if your balance is going to last you at least 30 years, and if not, what adjustments you might have to make. At $2 million, retirement becomes a risk problem. You probably have enough for a very comfy retirement, but managing your risk comes way more into question. And at $5 million, retirement becomes a purpose problem. The money isn't just a constraint at this level, but a much weirder question will show up in its place. In today's video, we're gonna walk through all three levels, and for each tier, we're gonna go over 4 variables. Number 1, how much income does that level produce? Number 2, what your tax bill might look like. Number 3, the single biggest risk at this tier. And number 4, my favorite, which is the psychological shifts that happen at each number. And by the end, you will see why the jump from $1 to $2 million matters much more than the jump from, say, 2 to 5. All right, so let's get into it. The standard calculation for figuring out what you can spend in retirement is all going to be based off of the 4% rule. This was invented some 30 years ago. You might have probably already heard about it, but it was subsequently studied by researchers to answer the following question. What is the highest withdrawal rate that survives any 30-year retirement window in US stock market history? The answer was around 4%, and since then it's been revised to around 4.5 or 4.7%, but for most of the financial community, we still prefer 4% because it's a safe conservative number. To illustrate how this works, let's say you start with a $1 million retirement portfolio. In your first year of retirement, you can withdraw 4% of your total balance, which is $40,000. Then the next year, you would take the baseline $40,000 out, and then maybe you account for some inflation of 2%. You might take out around $40,800, and so on every single year until you retire. The assumption here was that as long as your portfolio was split evenly 50-50 between stocks and bonds, you would not run out of any money back tested to any historical 30-year window of the market. So that means with a retirement balance of $1 million, you could withdraw $40,000 per year, and at $2 million, that becomes $80,000 per year, and at $5 million, that's around $200,000 per year. So most of you watching might already know this, and that's no surprise to me, but the raw withdrawal number that you take is maybe only 25% of the actual story. At each level of retirement today, those 4 variables are going to be constantly changing. Those are the same 4 that I mentioned in the introduction. So let's start with the $1 million retirement portfolio level. It's at this level that you are actually ahead of the average American. In fact, the median retirement account balance for people 65 and up is around $44,000 according to Vanguard. And the average retirement balance is closer to $200,000 according to the Federal Reserve's Survey of Consumer Finances. Now, both of these numbers are actually quite low. According to that same survey, only about 3 to 5% of retirees are going to have more than $1 million in retirement or more. So let me be clear, if you're on target for $1 million or more by the time you retire, you're already ahead of, let's say, 95 to 97% of people. Now, the real math at this level is the following. So in terms of category number 1, which is real income, you're going to be able to withdraw that $40,000 per year from your retirement account balance. In addition, the average Social Security payment in America is just about $2,000 a month per person. So that's $24,000 per year. That means if you have a household of 2 adults, you're going to be able to have $48,000 in that Social Security payments plus the $40K from your retirement account portfolio. So that's a total of $88,000 per year. Consider that the median working household in the United States earns around $80,000 per year. That means with $1 million in retirement, you will be out earning the median working family without having to actually, well, work. And that's pretty nice. In terms of number 2, which is the tax considerations, this is where it gets really fun. The $1 million retiree might have the lowest tax rate of their entire adult life because the standard deduction in 2026 is $16,100 for single filers, and for married couples filing jointly, that's actually double that, so $32,200. If you're over the age of 65, you can get an additional $3,300 combined in extra standard deduction. Also, if you're retiring before 2028 for some reason, there's a temporary bonus deduction of $6,000 a person or $12,000 a household, and this actually came out with the 2025 Big Beautiful Bill. So obviously, if you're watching this video in 2029, that might be phased out, but still, that's $35.5K of a standard deduction without the temporary $12K deduction added. That means, as of today, the $1 million retiree household can already have between $35.5 to 47K of their income shielded from taxes. You also have to consider that Social Security benefits are only partially taxable to begin with, so that's an added benefit as well. If you are withdrawing $40,000 per year of gains from your taxable brokerage account, you will pay 0% in long-term capital gains so long as your income is less than $98,900 filing jointly. That means if you were to have a well-structured $1 million retirement portfolio, you might be only paying a few $1,000s in federal taxes, and that's probably just for the Social Security portion. And in some years, you might actually pay nothing. So that's really nice. It's one of the biggest benefits of retiring with this amount. Now, let's move on to category number 3 now, which is what is the biggest risk that we have to consider with the $1 million portfolio? And I think that there is no bigger risk here than the sequence of returns risk at this level. Basically, sequence of returns risk means that your timing of your retirement really matters. If you retire and then immediately, let's say you go through a 2008 type of drawdown where the market tanks 20 to 40%, that's going to be a problem because you still have to tap into your retirement account for living expenses. You're also going to have fewer assets left because you're tapping into your retirement account when the market is down. So those fewer assets will not be able to generate as much growth during future recoveries. If you take a look at this graphic from Charles Schwab, you can see that Investor 1 and Investor 2, they both start with $1 million in their portfolio. Investor 1, however, they experience a 15% decline during the first 2 years of their retirement. And as you can see, by the time they hit year 18, they're close to depleting their entire balance. Investor 2 experiences a 15% decline after their 10th and 11th years of retirement. So you can see that the timing of this really matters here. If you experience that decline in the 10th and 11th years of retirement, Investor 2 is still going to have over $400,000 left at the end of 18 years. So while you can't really control the timing of when the market dips are going to happen, the one way to mitigate some of this risk is to keep a short-term reserve of low-risk investments like cash or perhaps short-term bonds that you can use to cover expenses in case there is a drawdown, and usually you want to keep around 1 year worth of expenses. I know that's not always possible for people, but I think that the point is that if you have an allocation of cash or short-term bonds, you're going to feel more comfortable with the market exposure of the rest of your retirement portfolio. Let's talk about variable number 4 now at the $1 million level, and that's the psychological bit here, and that's the fact that I think that budgeting will never stop at this level. Because your margins may be thinner at the $1 million amount, money is still going to be very much on your mind. That could mean that you're still maintaining a budgeting spreadsheet, or it can mean that you have to make some sacrifices here and there, and then if the market goes down 10% in a quarter, it actually might affect your mood. So that's something to consider at this level and just to be aware of, which is that you might not feel financially free even though you are, quote, retired. All right, so let's move on to the $2 million mark now, because at $2 million, this is the number that's more than enough for most Americans. 4% of $2 million is $80K, and that's how much you can spend every year in retirement where your portfolio can still sustain itself. If we were to add in the same $48,000 of household Social Security payments, that means your total gross retirement income is around $128,000. So right then and there, if you have $2 million in your portfolio, that means you're going to be drawing about $11,000 per month in retirement income. And that's going to put you in the top 15 to 20% of all American households in terms of income already, regardless of if you work or not. Number 2, let's talk about the tax picture now at the $2 million level. The first thing you need to be mindful of here are required minimum distributions. If most of your $2 million is in a traditional 401k or IRA, you are going to be forced to withdraw that money and pay ordinary income taxes on that money if you're over the age of 73. If you're born 1960 and later, that's going to be changed to 75 years old. That means on your $2 million portfolio, you could be forced to take out around 70K or maybe 75K per year in your 70s. And then on top of the Social Security payments you might be getting, that's going to put you into a tax bracket that perhaps you haven't visited since your working years. Now, luckily, in terms of capital gains here, even if you are taking $80,000 out of a taxable brokerage account in long-term capital gains, you're still sitting underneath that threshold before you need to start paying taxes on it. One strategy that people do here if they're worried about the RMD taxes is, let's say they retire at the age of 63 and most of their money is in a traditional IRA or 401k. They just convert chunks of that into a Roth. While they will have to pay taxes when they convert the funds from the traditional to the Roth versions, at least they are paying taxes during a time when their tax bracket is very low. If they do this for the next 10 years before they're required to take out minimum distributions, it could actually save them close to high 5 figures or even low 6 figures. All right, so moving on to category number 3 here, what is the biggest risk at the $2 million portfolio level? Well, I think number 1, sequence of returns risk is still going to be a factor, just like in the previous section. If you encounter a market downturn at the beginning of your retirement, it's going to make you rework your entire plan. But the actual biggest risk at this level doesn't sound like a risk, but it actually is, and that is underspending. If you've gotten to a point where your portfolio or your investment account is at least $2 million, you've probably spent at least 40 years accumulating money over and over. At that point, you're so ingrained in this behavior and habit that it's hard to flip the switch from accumulation mode to spending mode. My dad is a really great example of this. He spent his entire life thinking about money and accumulating it, and then when it came to retirement, he would still fly economy class, he would eat frozen meals, and he would keep driving his 12-year-old car, not because he couldn't afford those nicer things, but he could just not flip the scarcity mindset off. And if you're watching this channel, you actually might have the same problem, or you might be on track for the same problem, and this is something that I want to remind you guys of, which is that you don't take the money with you at the end of your life. One of the biggest risks for you if you have a $2 million portfolio is that you might actually end up with $3 or $4 million by the time you kick the bucket. That's the risk we want to avoid, so you're gonna have to find ways to spend that money, whether that's having a fun money fund or perhaps forcing someone like a financial advisor to give you a budget to spend every year. So what's really going on with the psychology here at the $2 million level? First, you're really not worried about having enough at this level. At least that piece is solved. When I've talked to people with this much money in their investment portfolios, they usually fall into one of two camps. The first is the type of person that thinks they need to play defense or that they need to protect themselves against themselves because they're afraid that they're going to take on a risk in their portfolio that could derail their entire retirement. The second is a person that has a much darker pattern, which is that when they get to $2 million, the goalpost moves. A lot of people that I've talked to that have $2 million bucks already, they want to hit that next milestone. So $2.5 million, $3 million, $5 million, etc. And there's a lot of survey data that actually backs this up, which is that essentially people at every single wealth level, they report roughly needing double what they currently have to feel secure. And I think I know why this happens, because for 40 years of your life or even more, you're used to a number going up in your bank account or your investment portfolio, etc. And that number is a reflection of how well you are doing at life. So when you finally reach the time when it's time to retire and to actually draw down that balance, you become, number one, uncomfortable, and number two, you might actually just create a new goalpost for yourself and you actually just want more money instead and continue that pattern of accumulation. So that's definitely a problem at the $2 million level, but what happens when you reach a number so big that mathematically money isn't a problem anymore? That's actually what happens at the $5 million retirement level. So at $5 million, it's at this level where the amount you can draw from your portfolio is $200,000 per year. And if you added the Social Security payments, that's another $48,000. So you're gonna have a gross income of around $250K when you consider your nest egg. Now, a real problem at this amount is that you will most likely die richer than what you started with. At lower tiers, the die richer outcome is possible, but it depends on flexibility, health, and luck. But at $5 million of a portfolio, it's actually the default outcome, and I think it requires a lot of effort to avoid that. $200K of spending money is more flexible than $40K per year like the $1 million portfolio has. So if something bad were to happen, such as a health-related issue occurs, and say you have to come out of pocket for $20,000, $40,000, the person with $200,000 a year is going to be able to weather that storm a lot easier. Because emergencies are dollar denominated and not percentage denominated, it's going to adversely affect the person with a lower portfolio much more. Another argument here is that a $200,000 lifestyle versus a $120K lifestyle per year is pretty similar at the end of the day. You might even have some years where you're just not spending the full $200K that you're technically allowed to spend with the $5 million portfolio. So that's something to consider. Now let's actually talk about the tax picture at the $5 million level. When you reach this echelon, it's really not about the income tax anymore. It's more about what happens to your money after you are gone. The good news is that the federal estate tax exemption is $15 million per person as of 2026 and up to $30 million for a couple. There might be some state taxes though, depending on what state you live in. So what this essentially means is that if you have $5 million and you're trying to pass it on to your kids after you're gone, they essentially will pay no taxes on that. There's also a step up in basis, which means that if you're passing on property with a low cost basis, it will automatically get stepped up to the value on the date of your death. That means if your kids inherit your property and then sell it, they might owe lower amounts of capital gains than they would otherwise by inheriting your cost basis. Of course, the trade-off here is that the recurring property tax amounts might get increased in certain states like California. But in both of these scenarios, these are questions about other people after you pass, and I'm sure after you pass, you're not going to even really care that much, but still, it just goes to show you that the more money you have, the more you have to worry about how other people are going to handle it. Versus when you have $1 million of a portfolio, you're really just worried about yourself. All right, category 3, the biggest risk at $5 million is not financial anymore. I just really want to emphasize that because you definitely have more money than you will ever need. One risk at $5 million you might encounter is that people are going to want your money and you essentially become a target of financial products, including life insurance, private placements, REITs, alternative investments, etc. And when you're older, perhaps your sense of judgment lapses from time to time and you might actually fall for some of these not so great financial products or maybe even financial scams. But let's move on to category number 4, the psychological part, because the biggest risk is also partly psychological. And that psychological shift, which is also the risk, is a matter of purpose. Because if you have $5 million in retirement, you basically have infinite security. Now, maybe security was the thing that you were working towards your entire life for, and now that you've achieved it, you might be starting to have some newer questions. You start to experience a shift in identity, and then you might start to ask yourself, why am I even here? The funny thing about life is that oftentimes our career and work does bring us purpose, and if you suddenly don't have a purpose anymore, your levels of stress might go up and you might become less satisfied with your life. It's at this level you might have to find a different purpose, and it doesn't mean that you have to go do something crazy like save the world or do anything like that. It could be as simple as helping your kids or grandkids, mastering a new hobby, or doing community service. So the question you might find yourself asking is, what is all this money even for? And that's the real thing you should be trying to solve on your way up to this portfolio amount. The happiest financially successful people I know are the ones who have the answers to what is this all for and have had plans for their money long before they were retired. All right, so now I want to answer why I still think the jump from 1 to 2 million beats the one from 2 to 5 million. In my opinion, the jump from 1 to 2 million takes you across a line, and that line is all about security. At $1 million or below, you have a plan that will work only if nothing goes wrong. At $2 million and above, you have a plan that will work regardless if things go right or wrong. In other words, there's going to be more security and more flexibility at the $2 million level, and that's when it really unlocks. You get the ability to not worry about sequence of returns risk as much. You don't have to worry about one-off expenses derailing your retirement, and you aren't worried all the time about budgeting. Now, don't get me wrong, the jump from $2 to $5 million is still really nice. It's going to give you options like perhaps you can fly business class and travel way more often, and you can maybe perhaps pass down that wealth to multiple generations if you're into that kind of thing. But those are upgrades within your retirement already, and the fundamental big shift has already occurred from the $1 to $2 million jump. So the takeaway here is that as you accumulate more money, it has diminishing marginal returns, and after you reach a good level of security, the next incremental 100K or $1 million might just be a number. So what can you actionably take away from this video? Here is my take. If you're on your way to the $1 million mark, I think that you are closer to retirement than what the internet will tell you, especially because you get Social Security to rely on as well. Having $1 million in retirement is definitely way ahead of the average American, as we've proven today. And even though it's just tier 1 in this video, just make sure that you understand that it's still really good. Like it's amazing. I just wanted to give you insights on what you could reasonably expect on your way to the $1 million and at the $1 million level. If you're between $1 and $2 million, then hopefully this video illustrates the fact that every additional dollar you save right now is very valuable for your future. This is the kind of stretch where if you're able to work one more year without stressing yourself out completely, perhaps it's worth considering, because it might be worth a lot of peace of mind if you're able to hit that $2 million and above mark. And if you're past the $2 million mark, or perhaps you're on your way to $2 million, with high confidence, I can say that your problem is no longer the number anymore, but it's rather a question of what is this money actually for? In future videos, I will share some tips and strategies to get you to your first $1 million, $2 million, and beyond, so make sure you are subscribed for that. I would love to know in the comments, what tier are you working towards? My guess is that most people are working towards at least $1 million, but do you have aspirations of $2 million and beyond? Let me know. If you're interested in my video on how far $250K, $500K, $750K, and $1 million take you in retirement, you should check out this video right here. All right, I will see you guys in that one or a future one on the channel. See you later. Peace.